Hey guys, the Federal Reserve keeps doubling down. They've come out again with some other statements. Every 2 or 3 days or once a week, you'll get a Fed chair president from one of the 12 districts that'll come out and make a statement. And when they make those statements, everybody listens. It's clues to what's going to happen going forward with the possible increases or decreases in the interest rates. So recently you had another Federal Reserve president come out and make some statements. So on this quick video, guys, let's talk about what was said, why it was said, and what that means for us. So let's jump into it, guys. So at this point, the Federal Reserve has given us 4 straight increases of 75 basis points. Now those are 0.75%, 0.75% increases to the federal funds rate. Now overall this year, that's 6 increases to the federal funds rate that we've seen and that has trickled down to our interest rates, right? On mortgage loans, auto loans, other variable rate loans like credit card loans, loans from banks, loans from lending institutions in general. They all have gone up as a result of these 6 federal funds rate increases, 4 at 75 basis points in a row. Now, as you guys know, the Federal Reserve is almost as much as a PR firm as they are anything else, right? We know their job is monetary policy to keep America building and growing and making sure we lower inflation and control inflation. We know all that. But for the most part, they come out a lot and they have things they want to say. And when they want to put a message out to get the markets thinking or to get the American people thinking, they'll come out and say certain things. You'll have a Fed chair of one of these 12 districts that will somehow make a comment if somebody asks a question. And that's what they do. They are as much a PR firm as anything, right? They have to present certain things to the American public because they know that the American public and the stock market and housing market, all of these different markets hang on what they say. So they're very careful about what they say. They're very, very careful about what they put out into the media. And so throughout a week or in between their actual meetings that they have where they determine the interest rates, the federal funds rates, you'll hear them come out and say certain things, but they're very, very careful about what they say and how they say it. I'm sure that they are coached on what they can and cannot say, especially the presidents of the different Federal Reserve districts. So recently, John Williams, who is the Fed president of the New York district, and he is the vice chair and permanent member of the Federal Open Market Committee. Now, the FOMC is the ones that set the rate. They're the ones who set and come up with the federal funds rate. So John Williams is pretty important, right? And so when he talks, people are listening. And so just a couple of days ago, he came out and said on some Zoom call or whatever he was on, some meeting, and made a few statements. It wasn't a press conference specifically for this, but these were responses to some things that he was talking about during the Zoom call. And one of the things he said is that we need to keep a restrictive, and these are his words, we need to keep a restrictive policy in place for some time. And he said that he expects that to continue through next year, through 2023. So in other words, what this vice chair of the FOMC said was basically, guys, that you will continue to see a restrictive, meaning a policy that's going to be increasing interest rates. And he also went on to say that borrowing costs, the cost to borrow, the cost of money needs to continue to rise in order to bring inflation down to where the Federal Reserve wants it to be. Now, keep in mind that the Fed's target inflation is 2%. We're almost triple 2% right now. He just told us that it's going to be through next year that we're going to have these restrictive policies. He also came out and said that he can see a point in 2024 when perhaps interest rates can come back down. So he's already saying that it's going to be through 2023. 2023 is going to be a rough year because interest rates are going to continue to go up throughout 2023. Probably not at the same pace that they've gone up, right? For example, we know the mortgage interest rates have gone up double this year, right? Started off the year around 3% for a 30-year fixed, and now towards the end of the year, we're in the 6s. And we had went over 7%, but it's come back down slightly in the last week or two. But mortgage rates have doubled. Now, I'm not going to say that interest rates are going to double again in 2023. But I can definitely tell you that the Federal Reserve is going to continue a policy that means rates are going to keep going up. Now, are we going to have a 75 basis points increase at 4 more straight meetings? Probably not. No, I doubt it. But guarantee you, they're going to keep going up. Now, John Williams also went on to say that the unemployment rate will likely increase to right around the 5% mark, which is basically what I've been telling you guys, that interest rates are going to really affect unemployment, and the unemployment is going to rise above the 3.7% that it's at right now. It's going to go up in the 4s and the 5s, maybe even 6s, in my opinion, once these high interest rates begin to affect inflation. It has to. Unemployment must go up. And why? Because it's a natural consequence when businesses start to feel the pinch as the demand for their product or service goes down. And that's going to happen. Inflation is going to drive demand down. These businesses are going to lower their prices, and when they lower their prices, they're going to have to cut workers. And when they cut workers, you're going to see unemployment increase. Low demand means I want to stay in business. I got to slash my payroll. I got to drop off 10,000 workers. I have to drop off 100 workers. Or I got to lay off 25 workers here and 50 workers there. That's just how it works. So John Williams has come out and said, expect unemployment to go higher. So what does all this mean? Some of you may be saying, hey, listen, this is just par for the course and it's what they do. Well, here's what it means for us. First of all, you're going to hear more and more of these Fed chair presidents coming out and making statements. All of the statements are going to be similar, and they're going to be making statements because they're talking to the American people. When they come out and say things, they're trying to sway markets. They're trying to sway public opinion. They're trying to sway public sentiment one way or the other. So get ready for more and more information to be coming down the pike regarding Fed chairs speaking out. You'll hear that more. But also, we should be preparing for the next Fed meeting, which is going to be December 13th and 14th. When they have that meeting, I want us to note that they're probably going to increase the federal funds rate, and that's going to affect mortgage rates again. So there's not going to be let up in interest rates for, say, mortgages. Some people are saying, well, I don't want to buy a home right now because, I think mortgage rates are going to go back down to the 3s and 4s. Mortgage rates won't be back down to the 3% or 4% range, in my opinion, for many, many years. I think it's going to be a long time. Can they come down to 5% in a couple years? Yes. But over the next year into 2023, the mortgage rates for, say, a 30-year fixed mortgage are going to be up in the 5 to 6 to 7 and maybe even the 8% range sometime in 2023. I really think that's coming. Now, for those of you that are looking to buy a home, maybe thinking about buying a home, maybe refinancing your home or want to move or have to move, these things are going to matter because they're going to affect the cost of money moving forward when you go and get that new home for that mortgage. It's going to affect it. If you need to buy a new car and finance the car, it's going to affect that rate also. The cost of money is only going to increase, and we keep hearing these warnings from the Federal Reserve and these Federal Reserve presidents. What they're really saying is this is going to continue, and this may get worse in 2023. That's why it matters to us. December 13th, December 14th, I'm predicting a 50 basis points increase to the federal funds rate, which is 0.5%. So we'll see. On this video, I want to give you an update, an idea of what's being said and what information is being given to the American public right now regarding rates into the future, rates into 2023. And when we hear the Federal Reserve President from the New York District, who is also the vice chair of the Federal Open Market Committee that actually sets rates, we need to be paying attention to what that person is saying, because that person is giving us an insight into what's going to happen moving forward in terms of the Federal Reserve's policy to control inflation and what they're going to do with interest rates. So listen, guys, if you got anything at all out of this quick video, do me a favor, smash the like button, subscribe if you're not a subscriber, and drop me a comment. What do you think is going to happen with interest rates going into next year, 2023? Let me know in the comments below. Hey, listen, guys, the best person to take care of the old you is the young you. Do me a favor, take care of yourself, and always take care of other people. Until the next video, peace.